In California, we are not a no-fault state when it comes to auto insurance. We must have liability insurance on our cars by law in California. The law requires we carry a minimum of 15/30/5 for an insurance policy. There is a California Fair Plan that exists, and if you qualify you can carry rates lower than the aforementioned 15/30/5. What the heck does this mean, 15/30/5? Insurance 101 right here. Let's break it down. $15,000, $30,000, bodily injury. $5,000, property damage. Think of it this way. If you are driving your covered vehicle and you hit another vehicle out on the road, parking lot, etc., the first $15,000 is if there is one person in the other vehicle you just hit and they are injured. $30,000 is the cap on the injury money and is there in case there are more than one person in the car you just hit and they are injured as well. So it is $15,000 per person up to $30,000 per accident. The $5,000 is for property damage, damage you cause to the other person's vehicle. Another property damage claim you may have to pay for is guardrails on the freeway. If you park your can inside the 7-Eleven, you will have to pay for that damage as well. As you can see, these limits are extremely low and don't afford you much coverage, especially the property damage portion. In California, they came up with these limits of liability back in the 70s when you could buy a car for $5,000. You know what you are going to get with $5,000 today? A down payment to car payments law. In our office you are likely to get 25/50/25 for an insurance policy because A, it's better coverage with $25,000 per person, you up to $50,000 per accident. B, you will have $25,000 to fix someone else's car you plowed into. C, it still isn't enough to fix a Mercedes, BMW, Cadillac Escalade, and a whole list of other cars out on the road, so you still have to be selective as to the car you hit, but it is better than carrying $5,000. You will see the price difference in the 15/30/5 policy and the 25/50/25 policy is roughly about $40 every 6 months. It is worth the extra loot to purchase a better policy. We will discuss uninsured motorist in the next article. When and why you will want to have this valuable coverage as an integral part of your insurance policy. What will the insurance company pay for my car once it has been deemed a total loss? Insurance companies typically pay what is called fair market value or actual cash value for vehicles. The way they determine this is much different than it used to be. In the old days they would simply go to Kelley Blue Book and look up the value. This is still a method used in today's valuations, but more and more insurance companies are using newspapers, private sales, and a few other clever ways to figure out how much your vehicle is worth. Many people think because they paid $50,000 for a 1976 AMC Pacer that the insurance company should have to pay what they paid. Guess what? If you made a bad deal on your vehicle, the insurance company does not partner up with you. Bad decision making. All in all, do you research on cars before you buy them and try to figure out the depreciation factor as you drive your car. Share this video and subscribe us for more auto insurance videos.